Basically, it is cheaper funds for HDFC. Beyond the point, it's not possible for an NBFC to fight with a bank on something like home loans. Banks get money for 3% on their savings deposits. So the biggest advantage for HDFC is cheaper funds. And then the bigger advantage for HDFC would be more branches. I don't know the numbers, it was 6,500 branches or thereabouts for HDFC Bank. HDFC has about 650 branches and therefore faster loan growth because of cheaper funds. For HDFC Bank, the advantage is much larger book suddenly. It's about 18 lakh crore. It's almost vying with the big boy, SBI. And it's a very big home loan book. About 30% of their combined book will become home loans. And that lends a lot of stability. It's the fast growing sector with a turn in the realty. And of course, it's a lot more weight in the Nifty and the Bank Nifty. It becomes the weightiest stock in the Nifty itself. But thereafter, let's look at what the problems can be. CRR on all the deposits that come from the entire source of funds of HDFC, almost entirely. Some long-term bonds may be excused. 4%, according to the Macquarie calculation, that will mean another 80,000 crore has to be set aside. Then, now because the book has expanded by about 4-5 lakh crore, you have to keep priority sector on a higher level. So, if a 40% of an 18 lakh crore book means an additional about 90,000 crore of agri loans will have to be given. Now, those are obviously low earning, high risk loans. Those would be the problems for HDFC Bank. The bigger point is, why is it now? These advantages of cheap funds were always available. Now, because NBFCs are of late getting regulated much more. Originally, NBFCs were light touch, but now the Reserve Bank is regulating large NBFCs almost like banks. They call it harmonization of regulations. Also, at this point in time, the cost of money is low. So if you have to get, you're taking money at 6-7% for HDFC, that is the price at which it absorbs money, and then it has to keep 4% idle as CRR, this would be a good time because the cost of funds is not high. So in terms of timing, it seems very good. But this hurdle is what I really want us to concentrate on. It's not necessary. They've asked for time, but Reserve Bank may not give time. They may say the day the merger is effective, your CRR and SLR must be in place. It's possible that they will not allow them to amortize it over time. Also, the priority sector loans, they could give permission for one, but certainly not for all the three, is the experience from previous episodes like ICICI Bank reverse merger. The stake in the insurance arms is what we have to worry about. The HDFC entity was allowed to own in insurance companies, but banks, RBI is very worried if they hold insurance companies, which is why, they have asked even ICICI, SBI to bring down their stake below 30%. Now, in the combined entity, HDFC Bank will hold 48% in the insurance companies. It is possible that Reserve Bank may want them to bring it down. People are talking about other legal interpretations, but it is possible that RBI insists on this and says that all the insurance investments should be pushed into a non-operating financial holding company. These are the possible things that we have to watch out for. Until the regulators sign off, it's not a done deal.